Stocks tend to get a lift overall when oil prices do rise, but this year stocks haven't always been performing the way many expect them to. And it is turning Wall Street's conventional wisdom, some of those cliches you hear, upside down. Bob Pisani takes a look at the reasons why.
The old Wall Street chestnuts aren't working, or are they? Several traders have inquired why the old chestnuts don't seem to be working anymore. As goes January, so goes the year. But the S&P is up 7% so far this year. Or sell in May and go away. But the S&P is up nearly 6% since the end of April. And August is the weakest month of the year, but the S&P is up fractionally, though it's still early. Now, what's going on? There's another major factor here. The presidential election years have an outsized influence on the markets, and when you layer in those signals, the markets are behaving in a fairly predictable manner. For example, the last 7 months of election years have tended to be strong, with just 2 losing streaks out of 16 elections since 1952. What about August being the weakest month? Well, August has been the weakest month for the S&P 500 since 1987. It's just the opposite in presidential election years. It's the 4th best month for the S&P, according to Jeff Hirsch at the Stock Traders Almanac. This may have to do with a post-convention bounce. How about sell in May and go away? It's not that simple. The correct rule is don't sell in May in the 3rd and 4th year of a presidential election cycle. That's how important it is. What about as goes January, so goes the year? The proper interpretation of this rule is that every down January on the S&P 500 since 1950 has resulted in either a new or extended bear market, a flat market, or a 10% correction, one of those 3. Hirsch insists that the January barometer did work with the correction that followed in January and February. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.